Alright, hello everybody. This is going to be a little bit different of a video. It's not going to be trade recaps, but instead I'm going to be teaching you guys just the basics of the stock market, the basics that I think everybody should know that can help you build wealth in the long term. Right? Trading can help you get rich in the short term because you're making bigger plays in shorter time spans, but then there's also the side of building wealth and making sure that you're comfortable throughout your whole life. So, and that's through investing long term. So, the first thing you want to know about the stock market, the US stock market, is that there's three major indices, as we can see here: the S&P 500, the Nasdaq 100, and the Dow Jones. So, we start off with the S&P 500. This is an index that tracks the top 500 US companies. So if we look in here, stocks like Nvidia, Apple, Amazon, Alphabet, which is Google, Tesla, are all within the S&P 500. On top of your favorite, like I don't know if your favorite, but McDonald's, Domino's, the big fast food corporations. Any big company you see out on the street is most likely going to be in this index. And as you can see, it runs back all the way to 1871 when cowboys are riding on horses still. And there's an overall upwards trend, especially if we go to the past, let's say 5 years. It's almost doubled in the past 5 years. $3,500. We're saying that's $6,400 per share in the index. And the way this works is that if you take, let's say, $100 a month, whatever it is, and you type in just investment calculator, and let's say here we are, start off with $0, and let's say you want to start pulling money out of this, or let's say see how much it grows 40 years from now. Let's say many of you guys are 20, 30, 40, whatever it is. The earlier you start, the better it is. Return rate on average is about 10%. Each of these three indexes, the Dow, the S&P, and the Nasdaq, are going to return about 10%. So say you invest $100, you should expect a $10 gain within 1 year, just from your money just sitting there and doing its thing. Doesn't sound like a lot, but it eventually begins to compound on top of each other. Let's say we add $100 a month at the beginning of every month, and it compounds annually for 40 years. $500,000 from just $100 a month. You take a bi-weekly paycheck, take $50 out of it, you throw it into the index. That's all you do, and just let it sit there. And if you scale it up and continue to let it grow, right? If you say $500 a month, now you're looking at close to $3 million by the time you're 60 years old if you start at 20. Right, and it just continues to grow and grow and grow. You do $1,000 a month, right? You can expect more. My plan eventually is to do $10,000 a month. I guess more. And you see the big guys out there that they're $50,000 a month, and they're bringing in who knows how much, $300 million, right? The next index is the Nasdaq 100. Here's the all-time, all the way back since 1985. The Nasdaq 100 is the top 100 U.S. tech companies. So Microsoft, Amazon's in there, IBM, AMD, Nvidia, Avgo, all your big chip companies, Apple. I think Sony and all these. And if you look up on Google and you type in Nasdaq 100 companies by weight, I'll show you what that means right now. So as you can see, here's all the companies within the Nasdaq 100. Nvidia makes up 14% of that. And what that means is that say you invest $100, okay, $100 into it. $14.43 of that $100 is going into Nvidia. $12.14 is going into Microsoft, $11 into Apple, $7 into Amazon, 6 into Meta, so on and so forth, all the way down to these 25 cents into Airbnb, and 6 cents into Global Founders. I never heard of that company, but it's part of the index. So, yeah, overall, here's a good long-term growth where the market has always gone up throughout time. So you don't got to worry about these big dips that happen. If anything, the best times to buy, because eventually it's going to pop right back up. Just like what happened with Trump's tariffs back in April, knocked the market down quite a bit. It was like 10% or so within a month. You buy that dip and then you launch all the way up to all-time highs. And that's going to repeat over and over and over again, hopefully, based on historical data. Now, if we go to the Dow Jones, all-time, here we are again. The Dow Jones is more of a selective index. It's only made up of 30 companies. If we go to Dow Jones, 30 companies. There we are. NVIDIA makes it up again. And say this one's doesn't show the weighting, but it's very specific. Couple techs, right? The big 3 techs. You got financials in there. You got your consumers in there. You got your medicine in there. Another medicine. All your oil companies. Food. A big combination of all the big companies from all different sectors in the market. So those right there are the 3 major indexes. And basically, if you just grab $100 a month, or even less than that, or more than that, whatever you feel comfortable with, you throw into the S&P 500, the NASDAQ, and the Dow 30, you can expect some solid returns. If we click into the NASDAQ, right down here, right, a 1-year return is 19%. All time is 18,000%. Well, a lot of us weren't born in 1985, at least I wasn't, so I couldn't do that. But 5 years, money's almost doubling. If we go to the S&P 500, 1 year is 14%, 5 years 85%, all times 143%. That's pretty crazy. $1 would be worth $143. Pretty crazy returns. Okay, so within the stock market, there are 20 different sectors, 11 big sectors, and then 9 minor sectors. So if we go from, where'd it go? What happened? Okay, there we go. So technological services make up $17 trillion of the stock market. It's the biggest sector out there. So those are, again, are your big tech companies, all the big names you hear of. The heavy hitters in the S&P that we went over, and the NASDAQ. As we saw in the NASDAQ, it was 15% was just to NVIDIA, which is the biggest chip manufacturing company, the biggest company in the world. NVIDIA is almost as big as, it has 4.5 trillion market cap, somewhere around there. It depends on the day, but it's bigger than just about every single stock market overall per country. So like the Chinese stock market, the Japanese stock market, it's huge, and it takes up a big chunk of the tech services and helps really push the U.S. stock market up. Right, electronic services is next, finance. So finance and tech are the big guys, and all these companies within these 3 sectors are within those 3 indexes we just talked about. Right, and then it goes to health, retail, energy, consumer, utilities, so on and so forth, all the way down to the miscellaneous sectors. Miscellaneous stocks that just don't fit in with anything. But the thing is, when you invest in the S&P, when you invest in the NASDAQ, you invest in the Dow, you're investing in all of this. You don't have to go in and pick individual stocks and pick this and that and that and that and see what works best for you. All you gotta do is throw your money into those three main industries I talked about. These three right here. And you're pretty much set. Alright, so in one of my classes for school, I showed this chart. And I like showing this chart because it tells you how the stock market moves overall. You know, sometimes when you first start investing, like when I did, um, I invested in the all-time highs of a certain time period, and my assets at the beginning went negative almost immediately. And what happens a lot of the time is people panic because we don't know any better. So if you look at the overall growth to overall decline in a market all the way back to 1958, there's much more growth. The blue is called bull market. Bull market means just growth upwards. A lot of green. Bear markets is downwards red. The reason I say it's bull because the bull hits up and a bear always claws down. So if we go to, let's say, the most recent right here, starting in 2020. If you look at 2020 on the graph, I don't know if you can see my mouse or not. If you look at 2020, see that we had 114.4% return in 1.8 years. That was after the COVID crash dip. Okay? But let's say for whatever reason you started investing in 2022. And in 2022, there was a negative 25% return. So if you started investing in 2022, all of a sudden all your money you put in, $100, you're down $25 on it. A lot of people get out of the market and say, it's not good for me. I'm going to keep my money in a bank account. The thing is, though, is that if you want to build wealth over time, you just got to let it sit there. As you can see, 2.3 years later, all the way up to current times, you're up 68%. So 68 minus 25, you're making returns, and it happens every single time. You go all the way back to 1958, negative 21% return. Next 4 years, we're up 86%. Just depends on whether you got into the market in a bull run, green, or in a bear run, red. But it really doesn't matter if you're trying to build wealth over the long run. Now, the last thing I want to talk about in this lesson is dollar cost averaging. So what is dollar cost averaging? Okay, we'll go to 3 months here. So this is the 3-month time span of the S&P 500 from May of this year, 2025, all the way up to current times, August 2025. So, say I started investing in the beginning of May, and I'm investing one time a month on the 25th. So I invested on the 26th. I invested on May 26, 2025, when the price was at $5,921.53. And I bought $100 worth of the index. Okay, let's go a month later to June 26th. Okay, at the moment, we're up. Our price when we first invested, write this down, was $5,921. And then we go to June 26th, now it's $6,173. If we do 6,173 minus 5,921, $252 difference in that growth. Okay? And say I invest again on June 26th. Your average position is not going to be back at $5,921. It's not. Because now you're investing again when price was at 6,173. So what happens is that this is what dollar cost averaging is. I invest $100 May 26, $100 June 26. It's going to bring it right to the middle, an average position of where you enter into the market. So it's going to be right in the middle of these two. So 252 divided by 2, 126. So basically 5,921 plus 126. It's going to be 6,047, which means that we entered right here at 5,900. We entered right here at 6,173. Now the average position between the two is going to be 6,047. It bumps it up, and now like somewhere around here, it bumps it up, and yeah, you're going to lose a little bit of money if it goes down because your position is now moved up higher. But overall, as the market continues to move up, you're going to be continue to be under it. And on top of that, major dips to happen are really nice. If we go to the 1 year time frame, right, our average position was like, what was it, 6,000 something, right, after investing in May and June. And let's say for whatever reason we bought back in April and we were in that position. Look at this, the market crashed all the way down to the 4,900, even 5,000, right, a whole $1,000 less. You invest a couple $100 here, now your position drops way lower. And this happens a lot of the time. You know, you could be investing up here, up here, up here, up here. Look at this nice little recession that we get, nice little pullback that we get. You can take all this time to continue to invest in the market, right? Dips here, dips here. This is going to lower your overall position to help you move up better. If you're going to actually invest in the market, you can't invest into the index. You can't just buy shares of the S&P 500. It won't allow you. But what you can buy are shares of a ETF, an exchange traded fund that copies those indexes. So for the S&P 500, the ones that I like the most, I like SPY the most, SPY. It moves the same exact way as that index would. It's just this allows you to actually buy the index. SPY, VOO. This is the Vanguard. I don't know if you guys know Vanguard. It's a big investment company. Same exact thing. So these are companies that release stock where you can buy and track index. That's for the S&P 500. Now for the NASDAQ, you have QQQ, which is tracks the NASDAQ. And for the Dow Jones, you have DIA. If you go into any app, Robinhood, Webull, you have a Vanguard, a Fidelity, a Schwab account, and you don't have an advisor or anything, I am not a professional. Nowhere near it. But I do know basics of the stock market. They're probably investing in this for you already. But if you don't have an advisor, you don't know where to start, you don't know anything about the market. Again, VOO or SPY, QQQ or DIA. You do, say you take $100, $33, $33, $33. Or you can do 50, 25, 25, 40, 30, 30, 50, 30, 20, whatever you feel is most comfortable for you. But just know that the S&P is the longest, which is SPY and VOO. That is the longest index out of the three that has continued to profit the most over time. But NASDAQ and the Dow Jones are very much similar. I myself do put a little bit more into the S&P than NASDAQ and Dow Jones. It's I do 40, 30, 30. 40 into the S&P, 30, 30 into the NASDAQ and Dow. And then now say we want to look at individual stocks. So the way I like to invest is a big portion of what I want to invest into is going to go into what I just showed you. For me, it's a 70-30 split. You can do 80-20, 50-50, whatever you like. Depends on your risk. But just know that investing into individual stocks, individual companies, is more riskier than investing into an index. Because say you invest into Apple. Apple's a great company. Great earnings, great tech, great everything. But one day they could fail. Right? We never know. Probably not. But when Apple takes a hit and you have all of your money to retire or all your money that you saved up your whole life just in Apple and the stock plummets to zero, there goes your money. But if the stock plummets to zero and you have your stuff in these indexes, yeah, these indexes are going to take a hit, but you're only going to lose maybe 20% max instead of 100%. Right? That's where the having all these other companies backing you up is going to help you out. So we just let's go to U.S. stocks, right? And we go to large cap stocks. Large cap stocks are much safer stocks. They're called blue chip companies. This is where these are companies that tend to been around for a long time, have great employees, great future growth, great earnings per share, um, always profiting every quarter. Uh, they're companies that have strong buy ratings and are most likely going to continue to grow over time. Again, Nvidia, the top dog right now, 4.44 trillion market cap. Right, Microsoft, Apple, Google, Amazon, Meta, which is Facebook. You got Walmart, J.P. Morgan, Berkshire Hathaway. I can guarantee you that if we took, no, I'm not gonna guarantee you. Can't guarantee. If you guys just took a couple of these companies, say you do my strategy, I do 70% into those ETFs, into those exchange traded funds that we just talked about, and 30% into companies, stocks that I like, that I prefer, that I think are gonna have good growth. I do 3% into Nvidia, 3% into Microsoft, 3% to Apple, which means that if I take $100, I'm gonna go $3 into Nvidia, $3 into Microsoft, $3 into Apple. I actually have it written down here. Here we go. Visa, MasterCard, JP Morgan, Amazon are some of the few companies that I like. Netflix is really good. Oracle is really good. Any big company you see around, Coca-Cola, it's Coca-Cola. And you can simply just ask ChatGPT anything it is. When you go ChatGPT, I'm not here to tell you what stocks to pick individually. That's for another video if you guys like, or for me to help you with, or you go with an advisor or whatever it is. But if you just ask ChatGPT and you say, what are some best stocks to buy for the long term, and it's gonna tell you. Right there, Apple, Microsoft, Alphabet, which is Google, Eli Lilly, Next Era Energy, boring stocks like Tractors, Domino's, are stable. Banks, right? Citizens Bank, J.P. Morgan, Goldman Sachs, Bank of America, Wells Fargo, AI, healthcare. Johnson and Johnson, Procter and Gamble. A lot of different stuff that you can pick from. But overall, again, if you invest in those 3 indexes, a couple stocks on the side, whatever you like, or just the indexes, you're going to have some sort of return most likely. Especially if you're looking at, say you go take on a nice job to get out of college, or you got a nice job going for you right now and you have the ability to invest $1,000 a month. That's be real nice in a couple years. Even if you're looking at 20 years from now, and you're 40, you're still gonna have some sort of return that's beating out your money just sitting in the bank account. And this is just money that's gonna sit there for you over time, build wealth for you, and help stabilize your future. So yeah, again, none of this is professional advice. I'm not professional. I'm a college student, and I just really like the stock market a lot, and I like sharing my information. As you guys know, I trade, but I also invest, because I know investing is what's going to build wealth. And what I'm planning on doing is taking my trading money, not all of it, or I want to build businesses and build other things around it, but I want to take, about 10K a month from my trading money and invest it into what I just talked about. And hopefully over time, that'll grow. And yeah, let me know if you guys have any questions, any comments, anything you want me to talk about. I'm here to do it. I'm here to help you out. I'm here to be there for you guys, and to learn from you guys too. And just let me know, please. I'm here to help. So yeah, thank you for your time, and I'll talk to you guys in the next video.